Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. Now, over the last month, there's something called a stealth rally happening in small and mid-cap stocks, or aggressive growth as we use it in our Dave Ramsey vernacular. If you go back to the beginning of this year, 2024, we mentioned by the way of our research partners, one of our research partners, FS Insights, that small and mid-cap stocks could break out as much as 50% this year. That was based on their performance over the last few years, lagging everything else, and the fact that they are currently priced at the same level that they were when they last catapulted into outsized performance over every other major benchmark. I bring this up because when you or I read about from any major publication in America, Wall Street Journal or any of the major news medias, they're constantly quoting the big three as it relates to the stock market. They're quoting the Dow Jones Industrial, the one that I personally dislike the most, the S&P 500, which is the one that I would say is the most relevant to the U.S. economy, and the NASDAQ 100, the technology stocks, let's call them. These three benchmarks all track large company stocks, which is great, right? I mean, those are the companies that you and I are tremendously familiar with, and the ones that have, over the last 10 years, been the best and highest performing. But over the last month, that has not been the case. And our argument around small and mid-cap stocks or aggressive growth might just be playing itself out right now. The Russell 2000, which again is our proxy for aggressive growth, has nearly doubled the S&P 500's return since the beginning of February. Now, is this trend going to continue to play out? Well, that depends on the economy and the markets. Thus, why we look at this video series each week to say, what are the economy and the markets doing? So let's dive into the economy first. And each week, we look at the Atlanta Fed's GDP Now model to determine if the economy this quarter we're currently in is in growth mode or contraction mode. The Atlanta Fed's GDP Now model gives us a real-time data that they're taking in and calculating what they think the GDP number is going to be. Last week, the number dipped to 2.1%, and as I mentioned, don't worry about that. That tends to happen intra-quarter if you follow this over a length of time. One bad data set pulls it down, and then we see it bump right back up if the economy is fine. And this week, after releases from the U.S. Census Bureau and the Bureau of Economic Analysis, we saw that number settle back in to the upside at 2.5%, slightly higher than a week earlier, and that was actually down a little bit after Thursday's release. They did a release earlier in the week. So good news here, still above the 2%, which was pretty much the baseline during the Obama years. Of course, not quite to the level we saw it when Trump was president. Next, let's check our thesis for this year's lower mortgage rates spurring the economy to success. And this week, we finally did get to see what we've been longing to see for the last few weeks, and that is both the 15 and the 30 years dropping simultaneously. We had weeks where one would drop, the other would bounce up. And they fell to 6.88% for the 30-year, 6.22% for the 15-year, respectively. So if you locked in during the last few weeks, see if you can undo that, because these rates should be a little better. Next, we look at the initial claims for unemployment insurance and the continuing claims for unemployment insurance each week to see if there are any cracks starting to form in the labor markets. And those numbers, we see that the initial claims, those coming on unemployment for the first time, crept up to 217,000 for the week. The 52-week high of that, by the way, is about around 265,000, so well below that number. And the continuing claims for unemployment insurance is still sitting at 1.9 million, and that reaches our pre-pandemic numbers. So unlike our initial claims, which are still below the pre-pandemic numbers, we're seeing the continuing claims back to quote-unquote normal as it relates to people staying on unemployment. And how about the markets? Of course, we look at the markets each week. The S&P 500, which is our proxy for growth and growth in income, but only when considered together, that was negative 0.26% this week, negative 0.26. The Russell 2000, which tracks our small and mid-sized stocks, what we just talked about earlier, or aggressive growth in our Dave Ramsey vernacular, that was positive 0.46% for the week. And finally, the MSCI EFA, which tracks international stocks in developed countries around the world, excluding the US, that was positive 1.6% for the week. So the international markets win the week, but aggressive growth did continue its stealth rally over large cap stocks, the S&P 500. How about point number 2? Let's look at the current price to earnings ratio of the S&P 500 to see if stocks look expensive at this point in time. The current number, which you see on your screen, is thanks to FactSet, and it shows the S&P 500 based on the index's forward price to earnings multiple based on current analysts' earnings estimates for the upcoming 12 months. So essentially, what do we think companies are going to earn over the next 12 months? This ratio helps to determine if the stock of a company is valued appropriately. The PE ratio helps to determine, is the stock valued appropriately for the industry it's in, how much it's growing. While this should never be a trading signal because things can trade at or below their historical PE ratios for a length of time, it does give us a semblance of where the entire market is trading at. Just one data point, there's many you should follow, but the PE ratio is one data point, and it measures the share price, which is the P portion of the equation, versus the earnings per share, which is the E portion of the equation. The current valuation on the S&P 500, according to FactSet, in those future earnings estimate is 20.4 times. And the 5-year average is 19 times, and the 10-year average is 17.7 times. So does that mean we're too expensive? We're going to come down? Because to get back to 19 times or 17 times multiple on the S&P 500, you would need to be around 4,425 to 4,750, and it closed Friday at 5,123. So you're talking about a 6 to 12% decline from current levels. And valuations are a factor of a few things. First, how confident are investors, you and I, about the future? The more sure we are that earnings will grow and that that's going to happen, the more we are willing to pay for those earnings, the higher multiple we're willing to pay. At this point, when you consider the last 10 years was us coming out of the great financial crisis, and that was a constant battle of we're going to fall back into some sort of financial or economic crisis. And you know, every TV station was constantly touting we're going to have a major crisis, followed by 2018, where Chair Powell of the Federal Reserve increased interest rates only to get a ton of pressure from President Trump. And then he dropped rates back down because of that pressure, then telling us through early 2022, no rate increases because of inflation, it's transitory, only to have them have to skyrocket interest rates to the moon in 2022. That gave a lot of uncertainty about interest rates, and you need clarity on interest rates. So I think that was a definition of we had no clue what was going to happen with rates, hence uncertainty of the direction of rates and uncertainty of the direction of the markets, hence why we had a lower PE over that period of time. Right now, multiples are higher than the 10-year average, but that seems reasonable to us considering that the Fed funds futures expect a rate cut in June and 3 more throughout the rest of the year. And from the Fed's indications, that is not out of the equation. Maybe not the baseline case, but it's not out of the equation. The key will be to watch and see how corporate earnings continue to flow in over the next quarter, because the fourth quarter's earnings are pretty much over, 97% wrapped up at this point, and we see year-over-year earnings growth coming in at 4%, which is the second quarter of positive comparisons and better than the 1.5% growth that was expected in December of 2023, right before earnings season kicked off. So we did a whole lot better than what we were thinking a few months ago. How about point number 3? Jobs, 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 and more jobs. February saw a strong showing with 275,000 new jobs added from the Bureau of Labor Statistics, exceeding economists' expectations, which thought the number would be closer to 198,000 for the month. This indicates continued employer demand for workers and a positive sign for the overall economy. It wasn't too hot and it wasn't too cold. However, there are signs that the market might be cooling down a bit as it relates to the labor market. The unemployment rate did actually jump up in this last report we got, and that jumped up to 3.9%, the highest it's been in 2 years. Additionally, we had revisions to January's jobs numbers, and they decreased the initial reports. Those numbers, when they were reported, were one of the best jobs numbers in a long time. We technically had one better one last year, but it was a phenomenal report. So no surprise that there were some revisions in those numbers. The January numbers were 353,000 new jobs, and they got revised down in this report to 229,000 new jobs. average hourly earnings, those rose 0.01%, and the Fed has to love that because that is a significant slowdown from the numbers we saw in January, which were positive 0.5%. Another factor to consider is the recent uptick in layoffs reported by Challenger Gray and Christmas Incorporated. While February layoffs were still lower than the pre-pandemic levels, they did represent the highest number for any February. So don't look at a bigger swath, but just look at a month. They were the highest numbers for any February since 2009. So this is something that we're going to continue to watch because if there's a lot of layoffs that continue, that could be problematic for the labor market. But we're not necessarily seeing that in the unemployment numbers, or the initial claims for unemployment, I should say. Job seeker sentiment right now might also be shifting. News reports mentioning the Great Resignation of 2021 are being contrasted with a potential the Great Stay phenomenon, the Great Stay, where workers are less likely to switch jobs due to concerns about the economy. They just maybe want to stay in place when the economy might not be as good. This suggests a more cautious approach from employees overall. And as you think about the U.S. labor market giving the Fed exactly what it wanted to see, that was this report. Job growth remains positive. It was not too hot. Wage growth is slowing down. It's not negative. You don't want that, but it's slowing down, providing a scenario where job switching is just not going to happen at a record pace. And that should manifest itself in increased productivity while the economy is still growing. Those are two very important factors that the Fed wants to see. And finally, point number 4. Here is interesting data released from Harvard this week. And according to this data, the economy is growing, but why don't you feel it? This is something I hear from people quite a bit. And I'll be honest, I track my spending. I don't feel inflation anymore. But some folks claim that they still do. And they claim it's horrible. It's the worst thing in the world. And why? I think this report found the answer for me. Harvard researchers believe that they've cracked the code. And by the way, I would never listen to a Harvard person as relates to their politics. But they think they've cracked the code on why economic indicators suggest a healthy U.S. economy, but many Americans don't feel the benefit. And their conclusion was this: traditional methods of measuring inflation, the key metric in there, is missing the mark. The crux of the issue lies in how inflation is calculated. The Consumer Price Index, CPI, the go-to method, tracks price changes for a basket of goods, right? So all these goods, how much did they go up? Harvard economists argue this approach overlooks one important factor: the rising cost of borrowing, a significant factor for way too many Americans, unfortunately. This found that factoring in increased interest rates explains over 70% of the gap between positive economic data and negative consumer sentiment. Very interesting, very interesting. Essentially, people might see low inflation numbers, but feel squeezed by rising interest rates on their mortgage, their car loans, their credit cards. All those have shot to the moon and continue to go up. This financial strain can outweigh any of the reported stability in the price of everyday goods. The researchers' findings suggest that a more comprehensive inflation measure, one that considers borrowing costs, like your mortgage, like your car loan, which we would say, hey, don't have, mortgage is the only good debt, could provide a clearer picture of the economic reality of most Americans. 7 out of 10 Americans are living paycheck to paycheck, most Americans. This new perspective could have a significant implication on these economic numbers. With a more accurate understanding of how inflation impacts everyday lives, policymakers could develop a more effective economic strategy around that, which could mean that more strain on the banks, which is why we would not be as in favor of investing in banks. Additionally, it could help bridge the disconnect between economic data and how people experience the economy, potentially leading to more targeted solutions of improved financial well-being of average Americans. How about something like Financial Peace University for most Americans? That would be the most targeted thing the government could do. However, maybe the person who created the calculation on CPI was a big Dave Ramsey fan, or just a fan of God's and Grandma's a way of doing things, and said debt isn't necessary, especially in times of higher rates. It shouldn't be necessary. So, stay away from it. Thus, I don't need to calculate it in the CPI number. We know that your income is your greatest wealth building tool, and the amount of years wasted on paying the banks as opposed to building wealth for your family is where many people run into the problem and thus get stuck in the wheel of continuous debt, continuous cycle of never really building and growing wealth. That's why we think the 7 baby steps, as taught by Ramsey Solutions and Financial Peace University, are the approach that most people should take. Yet, 7 out of 10 Americans are basically doing something that isn't working today. So, switch to Dave's plan. Now, we're in this weird situation because we get to see all these Dave Ramsey people, Ramsey Solutions people, the people that hate on Dave so much. There's a lot of them all over my LinkedIn feed that hate on Dave so much. They don't see these people. They don't see the changed lives. We see thousands. There are millions of people that have had their lives changed by just following Dave's simple, easy process. And oh, by the way, Dave would be the first to tell you it's not his process. Proverbs. Okay. A wise man leaves an inheritance to his children's children. And then Proverbs goes through the exact way to do that. Wisdom. Wisdom is from the true source of wisdom, which is Christ. So we hope this was helpful to you today, the 4 things we learned in the market. If it was, would you do us a favor? Do us a favor by hitting the like and the subscribe button. The like button helps us push our content out to more people on Google and YouTube and Rumble's algorithm so that our content helps more people improve their financial lives, as well as you can hit the subscribe button, and that allows our content to be pushed out to you as it's released, which includes our What We Learned in the Markets this week, our Question of the Week video, as well as any of our monthly webinars we do on topical things in the financial planning and investment world. As well as, if you would like to meet with any of our financial planners or coaches, you can go to the comment section of this video. The comment section, you can click on a link to schedule a meeting with any of our coaches who help you in baby steps 1, 2, and 3. Get out of debt, stay out of debt, live debt-free on a budget, or you can schedule a meeting with any of our financial advisors or planners who help you in baby steps 4, 5, 6, and they will help you create a plan to execute for retirement savings, help you pay off that house early, save for kids' college, so that you can live and give like no one else. Thanks so much. We'll look forward to seeing you next week.